Starting forex trading in 2025 can be very overwhelming. There's a million different strategies, indicators, and voices telling you what to do. But here's the truth. As a beginner, you don't need 10 different strategies. You need one simple, repeatable model. In this video, I'm going to show you exactly how I would start trading if I was brand new today. Before you place a single trade, you need to understand the basics, like what forex is, how our currency pair works, and what pips, lot sizes, and leverage mean. Without this foundation, trading feels like gambling, and with it, you start thinking like a professional from day one. So what is Forex? Forex equals foreign exchange. It's the global market where currencies are bought and sold. The market runs 24/5, open from Monday to Friday, and it's the most liquid market in the world. For example, if you ever traveled and exchanged dollars for euros, you participated in Forex. Now, what is a currency pair? In Forex, we trade pairs of currency. For example, the Euro USD. That's the Euro versus the US dollar. If you buy Euro USD, you're betting that the Euro will go up against the dollar, or you're betting that the dollar will get weak. And if you sell Euro USD, betting that the Euro will go down against the dollar, or the dollar will get stronger than the Euro. The first currency in the pair is called the base currency. The second currency is called the quote currency. So Euro is the base, USD is the quote. The base is winning when the market goes up, and the quote is winning when the market goes down. Now, what is a pip? A pip is the smallest price movement a currency pair can make, usually the fourth of a decimal price. For example, if Euro USD moves from 1.1000 to 1.1010, that's a 10 pip move. And pips are basically how traders measure profit and loss. Now, what are lot sizes? A lot is the amount of currency that you're trading. A standard lot is 100,000 units, a mini lot is 10,000 units, and a micro lot is 1,000 units. The bigger the lot size, the more money you'll make or lose in a trade. And as a beginner, you should start off at a very low lot size. And now, what is leverage? Leverage is basically borrowing money from your broker to control a bigger position. For example, with a 1 to 100 leverage, a $100 deposit lets you control $10,000 worth of trades. Although it can make you a lot of money, it can also make you lose a lot of money very fast. Once you understand these terms, open up a demo account. To open up a demo account, you guys can download MetaTrader. Once you guys download it, go to where it says new account, click the meta quotes, then click demo account, and then just fill in all the information it tells you to do, press register, and then start, and you guys should have a demo account. Risk management is the difference between beginners who quit and beginners who succeed. In 2025, prop firms and brokers are stricter than ever, so risk control matters. I recommend risking no more than 1% per trade. That way, even if you lose 10 trades in a row, your account is still alive. A lot of beginners fail because they strategy hop. In 2025, you don't need the fanciest indicators. What you need is one clean, proven model. For example, my strategy uses a top-down analysis. We go from the weekly, daily to 4-hour to determine the trend of the market. Then I look on the weekly and the daily to find nice support and resistance zones. And then I wait for price to tap in and reject those areas and drop down to the lower time frame so I can get sniper entries. It's simple, repeatable, and it works. After practicing on a demo and proving that you can be disciplined for at least 3 months, then move to a small live account. Don't chase quick money. Focus on following your strategy. If you can be consistent with $500, then scaling to $5,000 or even $50,000 is just a matter of time. Now let me show you guys how your guys' charts should look. The first thing I want you guys to do is look up TradingView, click it, press get started, and then you guys can use a free version. So just sign in, and then just do whatever you guys do, whatever it tells you guys to sign in. And once you guys sign in, go to the markets, probably gonna do all this, and then press that. Okay, so you guys' screen probably looks something like this. So the first thing we're gonna do is I want you guys to delete. You guys are gonna have a lot of different stuff right here. Delete all of the markets. Go here, press delete, and I want you guys to add all of these markets. So just take a screenshot of these markets right here and go to add them. So to add them, press this symbol right here. To make it easier, click Forex. Go click where it says all sources. Go to Oanda, and then just find them right here. All you gotta do is just add them right here. Click it, add to watch list, and then just do that with all of them. After you guys do that, I want you to right click on the market, click settings, go to symbols. I want you to unclick all of this, and then we're gonna go to canvas. We're gonna take off the grid lines, watermark, unclick that, and then all of this, if we keep it the same. Okay, then we're gonna go to indicators. We're gonna search up no gap candles because the market always has gaps in it. Right here. Then we're gonna click on it, click that little settings bar, click the visibility, or no, style, do body, do blue, this one do red, wicks, make them both black, and the borders as well. And this just makes sure that we can actually see the market and actually see exactly what it's doing. It makes it very clean for us. As you can see, this looks a lot cleaner than what it did before. Next, we're going to make sure we have the right time frames. So favorite the weekly, the daily, the 4 hour, 2 hour, 1 hour, 30 minute, and 15 minute. These are the exact time frames I use to break down every single trade. Next thing we're going to do is get you guys a little toolbar like mine. So we're going to favorite the trend line right here on that one. Head and shoulders, favorite these two as well. Favorite the brush, the path, and the rectangle, and the text. Okay, now that you guys' markers are set up, we're gonna go over the trend. What is arguably one of the most important things about this strategy. The trend is your friend. We do not want to go against the trend. Going against the trend is like swimming in the ocean current. If the ocean current is going east, you swim east. If the ocean current is going south, you swim south. If the ocean current is going south and you want to swim east, you're not going to get anywhere. In trading, the trend is bearish and you're trying to go bullish, you're going to lose money. You always follow the trend. The trend is your friend. So now I'm going to show you guys how to identify a trending market. So this market is trending to the upside, right? Because it's going up. This market is trending to the downside because it's going down. This is a bullish market. Bearish. Bullish, bearish. And in a bullish market, when the market is trending up, we have higher highs and higher lows. And a bearish market consists of lower highs, lower lows. This is a higher high, right here, higher high. This will be our higher low. Okay, so this is our higher low, it's our higher high. To create a new higher low and higher high, you have the body stick candle close above the higher high. The body stick candle close above this higher high. This becomes our new higher high, and then this becomes our new higher low. As you guys can see, we body stick candle closed above it again. Higher high, higher low. Body stick candle closed it again. Higher high, higher low. Okay, this is the market. Bullish market consists of higher highs and higher lows. This is the bearish market. High and lower low. So higher, lower high, lower low. We body stick for this one to go. To create a new lower low, you have to body stick candle close below this lower low. Boom, boom. This is lower high. This is our new lower low. We created a new lower low because we body stick candle close below this one. It's our new lower low. It's because our new lower high. We did it again. Lower low, lower high. That's how you identify if a market is bullish or bearish. And then the next step is to find support zones, support and resistance. So as you guys can see, price hit a block right here, right? Price hit a block and it went down. It went down, but then it broke through that block. And usually, market will come down and it's testing that block again, where it previously rejected from. It broke through and now it's using it as support to push higher, like right here. Boom, we broke through this. We had this block right here. Price hit it, went down, but then we broke through it and use it as support. So this is resistance right here. We hit it, went down, and we broke through it, and now we're using it as support. So support and resistance is basically when price gets to an area, it rejects it. So when price gets to this area, it rejects it. When price is above this area, it uses it as support. I'm going to show you guys more examples of this, but that's basically how it is. Support. Resistance is basically like you're hitting the ceiling, you're trying to jump through that ceiling, and then you hit the ceiling, you come back down, then you jump again and you break through that ceiling, come back and land on that ceiling, and then now you're using that ceiling as to jump even higher. You feel me? And it's basically the same thing here. You break under the ground, broke, and now it's retesting this area, broke and retest. Simple support and resistance. And that's how you determine if a market is bullish or if a market is bearish. Okay, yeah, we took a trade on this pair. Now let's break this down. Okay, so the weekly is bearish. We're obviously trending to the downside on the weekly, creating bearish market structure. Daily, we're creating bearish market structure on the daily and the weekly. The 4 hour is also bearish because we didn't buy the stick candle close above or below this area. We never created a new higher low. So this is all just market structure. Okay, now that we know the overall trend of the market, we have the weekly, daily, and the 4 hour all in sync bearish. So we're going to be looking for sales, obviously, because we go with the trend. So let's go back a little bit more actually. Let's go back here. So on the weekly, look for areas of interest within this range, right? It would be within this range right here, but there's obviously nothing really to the left. So I'm going to drop down to the daily, and I'm going to have this range right here to look for areas of interest. Just for support and resistance. Like I just told you guys before, we're going to find areas with support. As you guys see, boom, we touched this area, we rejected it and bought. Touch this area, rejected it, bought. Touch this area, rejected it. Touch this area, rejected it. That's 4 times. You need at least 3 times where price does that. It rejects the area. We have 4, so it's valid. So now all we do is wait for price to touch that area. Let's see. Okay, price gets into this area. Boom. So now once we hit the area, let's put this down. All time frames are the same, right? You have a daily area of interest, okay? Candlesticks rejection. This is when we're looking for candlestick rejections, like dojis, long wicks, engulfing candlesticks. Those are rejection candles. Okay, let's see if we have any rejection candles. Okay, we have a bearish engulfing candlestick right here. Bearish engulfing candlestick on the daily. Let's see, actually. We get that work? Yeah, we do get that work on. Okay. Bearish candlestick on the daily. Are we rejecting previous structure point? Yes. Previous structure point is what I was telling you guys. Boom. When we come back and retest that area, when we're coming back and we're testing that previous higher low, that is our previous structure point. Like I was telling you guys, we come back and use the roof as support to go and push higher. Or you use that ceiling to go and push lower. Like I was showing you guys earlier. Rejection. Well, I want to, there you go. Rejection from previous structure point. See that most previous lower low or that most previous lower high right here. That's gonna be your previous structure point. Okay, we're rejecting that on the daily. This is our most previous lower low right here. So we're rejecting previous structure point on the daily and the weekly. Okay. Put it down to the 4 hour. Our previous structure point. I mean, kind of. I mean, think this would be our previous structure point, but I'm gonna leave it. And we're creating a head and shoulders pattern on the daily. We had a candlestick pattern. This is a head and shoulders pattern. Sorry, let me put this down here. This is a head and shoulders pattern. Head and shoulders pattern is basically a reversal pattern. It's basically, as you guys can see, we're bullish, boom, boom. We shift bearish, we have a retracement, and then we push lower. It's a reversal pattern that I like to use that very successful. We also have this break and retest pattern on the daily. Like I said, this is a pattern when you break and you come back and retest that previous structure point. That's what we call a break and retest pattern. So there we go. And then EMA is this blue line. I forgot to give it to you guys. Here, I want you guys to go to indicators and search up EMA. Click on this and then go here to settings and put the length at 50. And this is all I have. There we go. And then yeah, this blue line should appear. And the EMA basically is just something I use as an extra confluence for all my trades. If the EMA is inside of my area of interest, I give that a 5% plus to my grade on either the 4-hour, daily, or the weekly. It's not in our area of interest on the daily, or the 4-hour, or the weekly, so I don't add it. And already at around psychological level. Yeah, we're kind of retesting around psychological level right here. The wick came up and was retesting this area of 0.47500. It's just this number in the price right here. Every 500 is around psychological level. So right here would be another around psychological level of 4,800. And yeah, it's just every 500 in price. We're retesting around psychological level. So far we have 105%. So when you see this, you should be like, when you enter a trade, you should be like, okay, yeah, this is perfect. Why should I not enter this trade? We haven't even gotten our entry signal yet. So boom, we break structure, we have a pullback and a engulfing candlestick. Okay, we shift this structure, we had a pullback and engulfing candlestick. Perfect. 125 A plus trade setup. Take the trade right here, put your stop loss 10 pips above this area, take profit down here, and then boom, as the trade is playing out, like I said, it created that head and shoulders pattern, but it wasn't valid until it broke through this area. So this candlestick right here broke it through this area, which made it valid. And once that area is valid, we come back. All we're looking for is a quick retest of that area to then sell. We got a quick retest, and then I got my engulfing candlestick. So that's when I entered. I was in a little bit of drawdown. Okay, and then we just let it play out. Boom. As you guys can see, both these trades hit take profit or add up to easy 1 to 6. And that's basically my strategy and why I took this trade. How EMAs, round psychologicals, rejection of previous structure points, candlestick rejections, what else? EMA, I think I said that. Yeah, that's how all that stuff works. My entry signal. And yeah, it's really simple. It's market structure and all that stuff. And now I'm going to show you guys how to enter a trade. So say we wanted to take a sell on USDJPY. We have a lot of support and resistance. Looks like we might reject this area. Put our tool right here. Take profit probably right here. Stop loss up here. So we have a 52.7 pip stop loss. You guys see that number up there? That's where the pips are. This take profit is a 152.6 pips. Now to calculate our lot size, we go over to my FX book position size calculator, and then we click or type in USDJPY right here. We're using USD, and our account size is $100,000. We want to risk 1%. Stop loss was what, 52.7. Trade lots, keep it at 1. And then you press calculate. So it's going to be 2.79 lots. That's how much we're going to do. So then we go on our phone and we type in USD right here. Type in USD JPY. Click it. And then it should pop up on the bottom. You click it right there. Press trade. And now where it says 0.01, you click that. And you're going to type in 2.79. You're going to, now we're going to go in, we're going to type in our stop loss number. We're going to type this number into where it says stop loss. So 1.47 or 147.553. And then we're going to type this number into where it says take profit. It's going to be 145.500. And then listen to the noise it makes. We're going to hit sell the market. Boom. And now we're in the trade. Down $11, $13. And now we just wait till it either hits our stop loss or our take profit. We're only risking $1,000, only risking 1%. Now that's not my actual strategy. That's not a trade that I would actually take. It was just an example on how you guys place a trade, how you guys calculate your position size, your stop loss, and your take profit, and how to execute a trade on MetaTrader. Forex is open 24 hours a day because different markets are opening and closing around the world. We have the London and New York sessions, which are the most active. Then we have Asia and Sydney, which are very slow. London and New York are the only two sessions I trade because, as you guys can see right here, this is when we have the most volatility. Usually in these sessions right here, as you guys can see, there's no volatility. And here's a tool on babypips.com. You guys can come here and search out for the Forex market hours, and it shows you what session that we're currently in. Right now we're currently in Tokyo session. Now, what is a funded account? A funded account is when a prop firm gives you their capital to trade after you pass their evaluation. Instead of risking your own 10K or 100K, you're risking theirs. In return, they take about 10 to 20% of your profits and you keep the rest. Most prop firms have a 2 or 1 step challenge evaluation before you actually get funded. Step 1, you have to hit about 8 to 10% of profit without breaking the rules or losing 8 to 10%. Step 2, you have to repeat the same thing but with a lower profit target of about 5 to 6 to prove your consistency. And if you pass both, you get funded. This is a funding platform that I like, Alpha Capital. So basically to buy a funded, all you do is come down here, press start your evaluation, sign in. Once you sign in, press add account. You can go with a 2-step, 1-step, or a 3-step. I like the 2-step. I go with swing. You want a $100,000 account. You use C-Trader, Trade Locker, DX Trade, or MetaTrader 5. And I would go with raw spread. Then you just type in all this information. So if you're starting trading as a complete beginner in 2025, follow these steps, learn the basics, practice on the demo, master risk management, stick to one strategy, and only then that's when you go live. If you want me to walk you through this process step by step, you can trade live with me for free, where I break down the markets every week. If you click the link in my description, and don't forget to subscribe so you don't miss the next video.